Good morning or afternoon, whenever you are watching this video. We're going to look at chapters 11 through 13 of our book here. Chapter 11, Financial Statement Analysis. All of you finance majors and undergrad are going to enjoy this chapter. We're going to look at what accountants have put together, which are the income statement, balance sheet, statement of cash flows, primarily. Or statement of cash flows, probably not so much in what's being used in this chapter, but your balance sheets and your income statement to do some analysis and fully understand the strengths and weaknesses of a company. It says on page 164, credit analysts at a bank run financial ratios to see how your company compares to industry standards. And of course it varies. What goes on in a automotive industry is going to be different than pharmaceuticals, which is different than healthcare, which is different than semiconductors or oil and gas. All these businesses are very unique. And that's what you learn once you get out of college, because most MBA programs are geared toward just a generic understanding. I know sometimes we think, well, I'm going to take a specific course that's going to prepare me for my job or my career, but you really get that industry knowledge once you start working and gain experience, and you will create a lot of really something that's marketable to the market and the industry that you are in, and you will tend to stay in that industry once you start gathering knowledge concerning that particular industry. Like I worked in automotive quite a number of years, and nuclear industry as well, which is kind of unique to sort of change gears. Now I'm in academia, but most people will become very knowledgeable in a certain industry, and then they can move around in those various companies that work in that industry. And that's what you will find, whether you're in accounting or finance or management, whatever that might be. So keep that in mind, as these are really generic courses that you are taking. So we try to hit with a lot of stuff here in the MBA program. So there on page 164, 165, the financial ratios, they start talking about the four areas. If you look at the bottom of page 165, profitability, set of ratios there. Utilization of assets, that's why you take your cash and invest those in assets, right? To drive revenue stream. We've been seeing that in some of these cases that we've looked at with WorldCom and waste management and that auto parts for materiality. What are they doing? They're talking about putting a lot of money, especially the auto parts, put a lot of money into their fixed assets, which requires more spare parts. And so they're putting money into those assets in order to drive revenue streams. Liquidity, solvency is very important. Surprised they don't put that one first here. That's usually how it occurs in most textbooks. And then debt burden. How much debt do you have? Anytime you go out and buy a house or buy a car, whoever you're getting the loan from or the mortgage they're also going to do a set of ratios for you to make sure you don't have too much debt, that you can service that debt through your net pay. So we look on page 166, and they have these profitability ratios, the gross margin or gross profit margin, and then the profit margin, return on assets, return on equity. They jump right into gross profit margin. I use that here if I can find it. There it is. Some time ago, put this in one of the other videos that shows we're on this side where the sun's not shining in. Right up here where my index finger is, revenue minus cost of goods sold is your gross margin. That's what they're referring to, gross margin. So your gross profit percentage is what? Gross margin divided by revenue, whatever that might be. That's your gross margin percentage. And then we subtract out, of course, your cost of goods sold is what? What have we learned? That is your product cost. It's on your balance sheet until it's sold. And matching that cost of goods sold expense with your revenue is being generated when it's sold. Then it comes off your balance sheet and goes to cost of goods sold expense. And then your SG&A are period costs. Some of you did a real good job of explaining that in that waste management case that we had. Selling general and administrative expense, period expenses, never goes on your books as an asset. Expense when incurred. And then that gives you your net income. I guess I'll write that on there. It's not just income, but you can have gross income. Net income. And so your net profit is going to be your net income, right? It's going to be your net income divided by your revenue. That's your net profit. So those are two basic calculations there on page 166, or excuse me, 166 and 167. Your gross margin is important because it's relating your revenue. Like we sold batteries, what you sell the battery for versus what was the gross margin, what was your cost of goods sold? Well, cost of goods sold was your direct materials, direct labor, and the overhead associated with your manufacturing process. So they want to know what your margin is. SG&A, yeah, that comes out of your margin getting net income, but that's not part of your revenue generating stream. SG&A is kind of like a necessary evil that you have to incur, right? All right, then you look on page 168, return on assets. It's net income divided by total assets. How did you use those assets? Whether you owe money on them or not, the ones that you have in your possession that you either own or you owe on, you've employed those assets. Well, how well did you do with your net income on that? And then return on equity that's what you actually physically own, right? Assets equals liabilities plus equity. Equity is what you own of your assets. Your liabilities is what you owe. What you possess is equal to what you owe versus what you own. Assets equals liabilities plus equity. And then there's asset utilization ratios on page 169. I don't remember that being listed there. Well, I guess it is. Utilization of assets. Accounts receivable turnover. Average collection period. Why is accounts receivable turnover important? Well, if the older your assets get, the older your accounts receivable gets, then the least likely you're ever going to collect, right? The older it gets, the more likely you're going to have to write that off as bad debt expense. Of course, under the accrual basis of accounting, you would have set up that bad debt expense as an allowance for doubtful accounts when the product is sold. Right? Recognize that bad debt expense at the same time that you have the sale. Even though you're just doing this as a percentage based on the past, it's not specific to any particular supplier or, customer. Now, you wouldn't be doing business with any customers if you thought they were going to default on payment. Average collection period, when you take that turnover ratio and divide it into 365, tells you how many days old your accounts receivable is, right? There's 360 days in a year in general, and you got a turnover of 12, meaning you're turning over your accounts receivable 12 times a year. Then what's your number of days? 360 divided by 12 is 30 days. So your average accounts receivable is 30 days old. Now, some of it might be 60, and some of it might be 15, or 1 or 2 or whatever. So 30 would be high. And what is that year over year, month over month? Is it getting worse? Is it getting better? Is your credit department doing a poor job if your accounts receivable days is increasing and your turnover is decreasing, right? Inventory turnover is the same way. What's your cost of goods sold divided by average inventory? How often are you turning over your inventory? And again, if your inventory is being turned over 12 times a year, 360 divided by 12 gives you what? 30 days. If your inventory is on your books for 30 days before it's sold. Fixed asset turnover, total asset turnover, a couple of others, but those first two, accounts receivable turnover and inventory turnover, very important in your business to manage. You as a general manager have to make sure that those ratios aren't getting worse, that they're getting better or staying the same. And then they give you the formulas for that on page 169, 170, 171. And then we get to the liquidity ratios, the current ratio. That's nothing more but current assets divided by current liabilities. And how do you define something as current? It's whatever you're going to turn to cash in the next 12 months. That's your operating cycle, 12 months or less. Accounts receivable, inventory, all of that can be converted to cash, marketable securities that can be converted to cash. And then that's compared with your current liabilities. That's what's going to require cash over the next 12 months. So you can see how you want to relate current assets with current liabilities in order to see if you're solvent, if you're liquid, if you can cover your current liabilities, all your payables, like the income tax payable, wages payable, accounts payable, all of those. And then you have something here called quick ratio. What in the world is a quick ratio? Another term for that is acid test ratio. And all you're doing there is subtracting out inventory. You can see that on page 172. Some textbooks have a real complicated calculation for that, but I love how they only subtract out inventory there. So why do you think they subtract out inventory for a quick ratio? Well, think about inventory. Inventory, sometimes you got inventory that is slow moving. It's not sold immediately. What do clothing stores have? That's an issue, especially when you get into January and February. They have all their half off and half of half and 90% off because they've got inventory that it's at the end of the season. It's slow. They're not going to be able to get rid of it unless they mark it down. Well, that's an issue when you got inventory calculated into your current ratio. So the quick ratio says, I'm going to take out all that inventory because the slow moving product maybe is obsolete, right? We had that issue in manufacturing of having maybe batteries we made for a customer that's no longer our customer, and we can't do anything with that battery inventory unless we write it down to from $60 to $20 to move it as a second, sell it to employees. Another issue is, what if you have inventory on your books that actually is scrap? It's worthless, won't even work. So those are all issues with inventory. It's why the quick ratio is oftentimes used to subtract out from your current assets and then divide by current liabilities. Another one's not listed on here is working capital. Now, I talked about that in another chapter because they have a whole chapter in here on working capital. That's current assets minus current liabilities. What's the excess of my short-term convertible to cash versus my liabilities? And then we have debt ratio, debt to assets, right? Top of page 173, times interest earned, fixed charge coverage, a lot of debt ratios there to see how well your company's doing. If it's not too heavily weighed down by financing through debt, it's always something companies have to look at. If it's publicly traded, issuing stock, whether it's preferred or common versus debt. Of course, preferred doesn't give up ownership like common stock gives up ownership, but you never have to pay it back. It's the thing about stock. You're giving up part ownership, but you're not having to pay that back like you have to do with bonds payable or notes payable. Debt has to be paid back. That's why there's so much focus on debt ratios. Page 175 is a concept called horizontal analysis. And you know what horizontal is. That's when you're comparing a year with the prior year. And you can do that with your balance sheet or your income statement. What was your cash now versus last year? That's what the cash flow statement does, but what was your cash year over year? What's your accounts receivable year over year? Maybe you got more revenue, making your accounts receivable higher. Maybe your accounts receivable is higher because your credit department is giving credit to people they shouldn't, and then they're not paying their bills. But you do that on any balance sheet account. You do that on any income statement account. What's your revenue year over year? What's your gross margin year over year? What's your net income year over year? What's depreciation year over year? You can do that on every single account. That's called horizontal analysis. Here on page 175, and they do a good job there showing horizontal analysis, right? On that next page for a balance sheet, assets, and then liabilities and owner's equity. You can do that on income statement as well. I also have a concept on 178, 179 about common size financial statements, where you're comparing with an industry. And that's pretty much where they end up. They don't talk about vertical analysis, which is something that's similar to horizontal, although with vertical analysis, you're comparing each of your line items with, in the case of income statement, your revenue. Revenue divided by revenue is 100%. What's your gross margin divided by revenue? That's your gross margin percentage. But you do that on every single account and compare year over year. Same thing with the balance sheet. What's the relationship between long-term assets to total assets, or current assets divided by total assets? So that's vertical analysis, which they really don't talk about here in this book. But you probably had that when you were in principles. I don't know if you had me in 2020, you did. Then on page 180, 181, that test yourself, those are good. These are good exercises. You're on your own to do this, to get the most out of this class for your future career. But test yourself, make sure you understand the answers on these. And that will help you in these case studies, because these case studies we're doing are narratives, but at the same time, you really need to drill down into the detail and give some examples, some numerical examples of the calculations necessary. It's just like the case we had on waste management with the change in salvage value and change in what? Useful life. Show what impact that has to depreciation by some examples. And some of you did a great job with that, but more of you need to do that. You need to show how that impacted your income year over year. And you don't have to use the numbers that waste management had. Just make up some numbers and just show what the difference is. Show that you understand what has taken place by the manipulation of the books. But the more you learn about what's in this very straightforward, simple book, and this one as well, the more you're going to be able to talk about that in those cases. All right, then chapter 12 is about budgeting, responsibility accounting. We should spend more time on budgeting in these college courses. So important. We're going to look at something similar to that in the very last case, the Excel assignment on flex budgets, because that is so important, whether you're a not-for-profit, and I did some work for a $7 million a year in revenue not-for-profit versus a $400 million a year for-profit. Flex budgeting is critical. Your auditors are going to ask for that. Even at this small company I work for with $7 million a year in revenue, they wanted to know what was your original budget and did you flex that budget? Did you change that? Of course, they didn't say flex. They said, did you change that budget during the year based on a change in your operations or change in your financial funding? And so they wanted to see a budget that's been changed, because when you change your budget, that means you're trying to control your organization. If you're not changing your budget, if you're just throwing one out there and that's it for the year, your auditing firm's going to look at that you're not in control of what you're doing in your company. And that's a real key part of them looking at your financial statements. They want to know everything about what's going on in your company. And so this chapter on budgeting, responsibility accounting, which the university here is trying to push down to the college level, very, very relevant today. So budget is a tool to control your spending, right? Whether it's a small church or a not-for-profit or a $400 million plant or a $15 billion corporation that plant would be a part of, budgeting is critical to controlling what's going on in your organization. And it's a long process. We'd start in mid-December at Exide and we wouldn't finish it till usually the 1st of March. By the time we had it finished and approved by our corporate office, then they would roll the standards, the cost standards for the next year based on those budgeted amounts for what we were going to manufacture. They would roll that in. Your standards were based on the budget. That's why it was critical to meet those budgeting standards, because that's what you were costing your product as. And if you're costing your product at that, that's what you use to price your product. And then when you got to the end of the year, if it wasn't accurate, if you missed your budget, then you were going to have to take a big hit to your financials to cost of goods sold, right? That's how you clean it up, write it off the cost of goods sold if you were over budget. The problem is you didn't put that in the cost of your product all during the year. So you actually potentially could have had a loss on something. But the budget process, bottom page 187, request and collect budget estimates. What's the cornerstone of the budget process? You remember that from principles? Your sales forecast. And your sales forecast can't be a pie in the sky. It's got to be some realistic forecast of what your sales are going to be, using percentages, the likelihood of getting new business. Are you going to keep your old business? And your sales budget will drive your production, your supply chain logistics, your budget for production. Where is that production going to be? It's going to be in Kansas, it's going to be in Bristol, it's going to be up in Maine. Where's it going to be? Is it internationally? Where are you going to build what you're going to sell? And all that logistics, the cost of freight has to be entered in. Where's your tooling to make certain types of batteries versus other types of batteries? Very important part of the process, but sales kicks it off. Then production, and from production, then you have your materials budget, right? What's the big three? What's your inventory for raw materials, direct labor, overhead? All three of those roll into what? Work in process, and ultimately finished goods. And then when it's sold, cost to get sold. But all those, the big three, you have to do budgets for those. You got to do a budget for SG&A. Then you got to do a fixed asset budget. How much cash you got? How much fixed assets are you going to invest in? And the depreciation from that feeds back to your operating budget, right? Got an operating budget, got a capital budget. They run concurrently. Capital budgets is how much cash are you going to put into your fixed assets. And then the depreciation comes back to your operating budget. And of course, your operating budget, you're going to generate income statements, balance sheet, income statements by month, balance sheets by month, and cash flow statements. All of that's a big part of this, and it's a long, drawn-out process. They talk about that on 188, revenue or sales budget. See, that's where it starts. Sales budget, production budget, right? There it is, materials, labor, and overhead. Cost of goods sold budget, research and design, or research and development. What do you do with research and development costs? Well, they're not a cost, they're expense when incurred. It's never capitalized. Marketing budget, that's going to be expense. Capital expenditures, that's cash going into my assets. Pro forma income statement, balance sheet, statement of cash flows. What is your budget? If you meet that budget, which is both operations and financial, what kind of income statement and balance sheets is that going to look like from your plan? And then you got variance analysis all during the year. You got to drill down into that on page 190. What's the cause? The activity, corrective action, never ends. I'll tell you something else they don't talk about in here is the forecasting process. So what's the difference between budget and forecast? The budget is what you put forth at the beginning of the fiscal year. Again, our fiscal year ended in March 31st, because it's a slow time of the year, right, for batteries, just like most of these merchandising clothing stores, their fiscal year ends in February, slow time of the year. But back to Exide with March 31st, from middle of December through almost the end of March, the time the standards were rolled before our fiscal year started on April 1, we budgeted the whole time with all these various scenarios of production. Well, what if we get this customer? What if we lose this customer, right? But once your fiscal year started in April, very first week, I had to do a forecast on what our numbers are going to look like for April, based on our production, right? Based on our spending. How efficient were we? Were we efficient with what? Labor? Were we efficient with our materials? How's the overhead spending? Is your electric bill higher than you thought or less? So all of that, we had to forecast every week, 52 forecasts a year. And once you got to the end of the month, after doing 4 forecasts, then you would close the books for the end of April and compare that to budget, compare it to forecast. And then what would we do? We would do a what? We do a 1 plus 11. What's a 1 plus 11? 1 month is over of actuals, and then you had 11 months of forecasts, which may or may not be the same as your 11 months that were budgeted, right? Because things change very quickly. I mean, if you finish your budget at the end of February, you spend the month of March rolling your standards from that budget, you get into April. At the end of April, you got 2 months in from the budget that you finished at the end of February. You got to do a reforecast. And if you've lost a customer or gained a customer, they were always wanting to know what's your new budget. And that's what the flex budget does. It flexes your variable costs up, or it flexes your variable costs down, just like it flexes revenue up or revenue down based on your volume. Whatever is variable gets flexed. Your fixed stays the same. So you can see how your profitability is going to change based on flexing those costs based on the volume of what it is you're selling or producing. But that was never ending. I mean, going from budgets into forecasts. So he needs a whole chapter in here on forecasting. It's that important. He does talk about standards there on page 190, 191. And we just don't have time to go into the whole standard setting process. I touched on that a little bit. But your budget, your operating budget, is what's feeding your cost standards. It's not based on historical. I mean, yeah, your budget's based on historical information plus new stuff, but your budget is being rolled, or your standards are being rolled in March for the coming year based on your budget. That's how important the budget is. And it's just something that, well, here's a budget and it'd be nice if we can hit it, but it's okay if we don't. That is not how budgets operate. You have to meet that budget. It's that critical. And we had 9 plant managers in Bristol for 19 years. 9 of them. And 8 of them, only one of them got promoted. The other 8 pretty much got let go because they couldn't hit the budget. They couldn't hit the production and or the financial spending. So that's why they would get rid of them. It's that important in your large companies, or any company for that matter. You got to hit these budgeted numbers. And your volume drives your financials, right? Sometimes there's things financial that have nothing to do with your volume, like you've got an environmental mess or just who knows what's going on, but your production volume and your quality drives your financial performance. That's why it's so important for you to understand the whole gamut of what goes on in business. In your business, the more you learn about the company you're working for, you think, well, I don't have anything to do with production. I work in accounting, or I'm in HR. I don't care about quality. That is not how you should be viewing your job with whoever you're working for. You want to understand everything about that business. Your CPA firms that are doing the audits, your external audits of various companies, they want to understand your business. So they can help you, not just audit your books, but so they can help you and give you advice to be a better company. And then responsibility accounting there on page 193, cost centers, revenue centers, cost centers. Important stuff there. You can read that on your own. Page 195, 196, again, do these tests. The answers are in the back of the book. If you look at the answers as you go through it, make sure you understand what's going on there. It will help you in your career. Then chapter 13 is about the time value of money. Some people really get scared when they start talking about present value, right? Present value of an annuity and present value of a lump sum. But all of you, if you major in accounting or finance, you probably know how to do this already. It's very important about present value. And of course, they start off on 202 and 203, 204 about future value. And what are they using future value for here? Well, a good example that I learned back very early is, what if I put, back in the day, it was you could put $2,000 a year in an IRA. Of course, that was tax deferred, but now you got the Roth IRA, which is obviously a better route to go. Is pay the tax now so you don't have to pay it later. But if you put $2,000 in a year for 40 years, what's that going to be worth at the end? If you assume 4%, you used to say 10%, but that's not realistic anymore. 4%. I think that's what the state of Tennessee uses for their pension projections. They used to use 6.5%, and they changed it about 6 years ago to 4%. That'll tell you something about the future returns on the market. But what does that equal? That's what you use as future value. You've got all kinds of Excel formulas to use that now, or you can use the tables to calculate that. But future value of a lump sum is simple. Future value of an annuity, like the $2,000 a year, it will tell you exactly what that's going to be worth, used by wealth managers in trying to extrapolate what someone needs in order to retire at a certain age. But that's future value. And then page 206, 207, present value, you use that a lot of times for stuff. But what's the present value of an investment, right? The cash flow coming back, present value, and prioritization of a capital project. But I got to tell you, most of the time they use payback period. What's my total investment divided by how much cash am I going to get returned each year? Very simple, payback in years. But present value is always used at the same time because you're using these Excel spreadsheets that will do accounting rate of return, internal rate of return, net present value, all 3 of those, plus you got your payback period. Make my fingers work. Payback period. But everybody looks at payback period because it's simple. Nobody ever talks about return, but you as financial people, or you as non-financial people, need to understand that there is present value. Use it a lot in accounting for things like present value of bonds. Those of you majoring in accounting know what I'm talking about. Present value of your lump sum of your payment in bonds, as well as the actual interest payments. And if it's an investment, the receipts from the cash. So that's a fairly quick chapter there. They only have one page of questions on page 210, right? In chapter 13. So, all right, so that's those 3 chapters. We'll pick up again the next video with either a case or chapter 14. Hope you have a good day.